Let me ask you something. When was the last time you felt genuinely confident about your investments? Like, not just hopeful, actually confident. For most people, the honest answer is never. Or maybe once, right before something went sideways and you swore you'd never do that again. Here's the thing though. The reason most people never feel confident isn't because they're bad at math, or because they don't have enough money, or even because the market is unpredictable. It's because they've been taught one particular investment strategy completely backwards, and I don't mean slightly off. I mean like showing up to a marathon and running the wrong direction confidently the whole time and wondering why you never cross the finish line. I've watched people with solid incomes, decent savings, and genuinely good intentions make the same fundamental mistake over and over again. And the wild part, the more they learn about investing, the more confidently they make this mistake, because it's baked into almost everything you read, everything a well-meaning relative tells you at Thanksgiving, and every generic finance article that says just invest for the long term, without ever explaining what that actually means in practice. Today I'm going to show you exactly what that mistake is, why it's so easy to fall into, and what it actually looks like to do this right, with real numbers, real scenarios, and zero fluff. My name is Tate, and I study how ordinary people build real wealth without needing a finance degree or a trust fund. If you've ever felt like you're doing everything right, but your money still isn't working as hard as it should, make sure to subscribe and hit that like button if this helps you see things differently, because by the end of this video, you're going to understand something that most investors, including some pretty experienced ones, have fundamentally wrong. And once you see it, you genuinely cannot unsee it. So let's talk about why this matters so much right now. We are living in one of the most confusing investing environments in recent memory. Interest rates have been doing things nobody predicted. The stock market has had stretches of historic gains, followed by gut punch corrections. Inflation has eaten into real returns in ways that didn't show up on paper but absolutely showed up in people's lives. And in the middle of all this chaos, the average American household has less than $65,000 saved for retirement. And that's the average, which means half of people have less than that. Here's what most people don't realize. The problem isn't that people aren't investing. More people have brokerage accounts and retirement accounts today than at almost any point in history. Robinhood, Fidelity, Vanguard, account openings have exploded over the last several years. People are investing. They're just investing in a way that quietly destroys a significant portion of their potential returns, and the damage is invisible until it's too late to fix it. The reality is that studies consistently show individual investors underperform the market by roughly 1.5 to 2 percentage points per year on average. That sounds small. But let's run that number real quick because this is where it stops being abstract. If you invest $500 a month for 30 years and the market returns 8% annually, you end up with about $745,000. Now, if you underperform by just 1.5%, so you're earning 6.5%, you end up with around $567,000. That's a $178,000 difference from 1.5% over the same time period with the same monthly contributions gone. Not because of a crash, not because of bad luck, because of one consistent, correctable mistake made month after month. And here's the part that actually stings. Most people making this mistake have read investing books. They know what a Roth IRA is. They know index funds are good. They've heard of dollar cost averaging. They think they're doing it right. That $178,000 gap exists even among people who consider themselves reasonably informed investors. So what is the mistake? Let's get into it. The strategy almost everyone gets wrong is not what you invest in. It's when and how you respond to what's already happening in the market. Specifically, it's the almost universal tendency to confuse activity with strategy. And this shows up in three very distinct ways that I want to walk you through. But here's where it gets interesting because the first way this plays out is so counterintuitive that most people will push back the moment I say it. The first way people get this wrong is by trying to optimize their entry point. In plain English, waiting for the right time to invest. And look, I get it. It feels smart. Why would you put money into the market when it's at all-time highs? Shouldn't you wait for a dip? Maybe wait for things to settle down a little? Here's the math that destroys that logic. JP Morgan did a study tracking the S&P 500 over a 20-year period, roughly 5,000 trading days. If you were fully invested the entire time, you'd have averaged about 9.5% annually. If you missed just the 10 best days, 10 days out of 5,000, your return dropped to around 5.4%. Miss the 20 best days, you're at 2.1%. Miss the 30 best, you actually lose money. And here's the kicker. The best days in the market almost always happen right in the middle of the worst periods. 7 of the 10 best days in that study occurred within 2 weeks of the 10 worst days. So the investor who said, "I'll get back in when things calm down," almost certainly missed the recovery entirely while sitting in cash feeling clever. The correct strategy isn't timing the market. It's time in the market. You've probably heard that phrase before, but knowing it and actually behaving accordingly are two completely different things. Now you might be thinking, okay, but what about people who genuinely did see crashes coming? What about investors who got out before 2008 or before the 2020 COVID drop? They made money, right? Sure, some people did. But for every person who successfully called one crash and got out at the right time, you need to ask, did they also get back in at the right time? Because data from 2020 is actually really useful here. Between February and March of 2020, the market dropped about 34%. Then, between March and August, it fully recovered and kept climbing. The investors who panic sold in March locked in a 34% loss, and the ones who stayed put were back to even by summer. The ones who tried to time the re-entry and waited for confirmation that the recovery was real, many of them missed the first 20 to 30% of the bounce. Timing the market requires being right twice. Almost nobody is. Here's the part that will blow your mind, because the second way people get this wrong is actually the opposite behavior, and it's just as damaging. Some investors don't bail out. Instead, they go hyperactive. They see something working and they pile in. They hear about a sector that's on fire and they rotate into it. They read about a stock that's up 40% this year and they think there's still room to run. This is called performance chasing, and it is one of the most thoroughly documented wealth destroyers in the history of behavioral finance. The pattern goes like this. An asset class has a great 12 to 18 months. It shows up in headlines. Everyday investors start buying in. The price is now inflated by late arriving demand. The original tailwinds that drove the performance are either gone or priced in. The asset corrects or stagnates. The investor who bought at the top either holds through the pain or sells at a loss and cycles into whatever is now looking good. Repeat, forever. You can see this in real estate in 2005 and 2006. You can see it in crypto in late 2021. You can see it in AI-adjacent stocks in various stretches of 2023 and 2024. This isn't a market problem, it's a human psychology problem. Our brains are genuinely wired to chase what's working and avoid what's painful. In most areas of life, that's a useful instinct. In investing, it is catastrophically expensive. So, what does the right behavior actually look like? It's almost boring to say out loud. You pick a diversified allocation that matches your time horizon and actual risk tolerance. Not the risk tolerance you claim to have when the market is up, but the one you actually have when you're watching your account drop $30,000 in a month. You automate consistent contributions. You rebalance occasionally to maintain your target allocation, and then you do the hardest thing in all of investing. You leave it alone. But here's where it gets interesting for the third time, because there's a version of leave it alone that is also wrong. And this is the mistake that more conservative, long-term minded investors make. It's the assumption that asset allocation is a set-it-and-forget-it decision for life. Your allocation needs to evolve as your life evolves. A 28-year-old with 35 years until retirement can hold 90% equities and stomach significant volatility, because time is the antidote to short-term losses. A 58-year-old with 7 years until retirement absolutely cannot hold that same allocation and call it a long-term strategy, because for them, the long term is actually pretty short. I've seen people in their late 50s holding 85% equities because they started investing in their 30s, set their allocation, and genuinely forgot to revisit it. Then 2022 happens, and they lose 25 to 30% of their portfolio value at exactly the moment in their life when they have the least time to recover. That's not bold investing. That's an age-inappropriate allocation that was never updated, and it can delay retirement by years. So, here's what this actually means when you put all three of these together, because this is where the whole picture snaps into focus. The The one investment strategy everyone gets wrong isn't a specific fund choice, or a market sector, or a savings rate. It's the relationship between emotion, behavior, and time. People underperform not because they pick bad investments, but because they respond to their good investments in bad ways. They leave too early, they pile in too late, they set an allocation once and never revisit it as their life changes. Let me give you a concrete example. Take two investors, let's call them Marcus and Jamie. Both start with $10,000 at age 30. Both contribute $400 a month. Both invest in a broad index fund averaging 8% annually. The only difference is behavior. Marcus checks his account constantly. When it drops more than 10%, he moves to cash until things stabilize. When he hears about a sector doing well, he shifts some allocation toward it. He's not reckless, he genuinely thinks he's being strategic. Jamie automates everything, checks in twice a year, rebalances annually, and shifts toward bonds gradually starting at age 50. By age 65, Marcus has roughly $620,000. Jamie has $980,000. Same market, same contributions, same fund. The $360,000 difference is entirely behavioral. That's the cost of trying to be clever with your money instead of consistent. So here's exactly what to do with this information, because understanding it intellectually is only half the battle. First, automate your contributions, remove the decision from your hands. I set up automatic transfers into your investment accounts on payday, so you never have the opportunity to decide whether this month feels like a good month to invest. It always feels like a bad month when you're paying attention. Second, define your actual risk tolerance right now, not in theory. Ask yourself, if my portfolio dropped 30% tomorrow and stayed down for 18 months, would I stay the course or would I panic? Be honest. Then build an allocation you can actually hold through that scenario. Third, schedule an annual review, one date per year where you check your allocation, rebalance if anything has drifted more than 5% from your targets, and ask whether your allocation still matches where you are in life, not monthly, not quarterly, once a year. Fourth, stop reading daily financial news as if it's actionable. It almost never is for long-term investors. Market commentary is entertainment. Treat it that way. And fifth, this one is underrated, find one person in your life who will talk you out of panic selling. Seriously. Whether that's a financial advisor, a financially savvy friend, or even a forum community of long-term investors. Social accountability during market downturns is one of the cheapest and most effective tools available to retail investors, and almost nobody talks about it. The market will go up, it will go down, it will do things that make no sense. What you can control is your behavior, your allocation, and your consistency. That's it. And it turns out that's enough. The investors who build real wealth aren't the ones with the best stock picks or the sharpest market timing, but they're the ones who stayed boring for 30 years while everyone else was being clever. If this hit different than your typical finance content, subscribe, because this is what we do here. Real numbers, real behavior, real results. See you in the next one.